Good morning, ladies and gentlemen. My name is Gareth Alston. I'm the Deputy Chair of the Investment Analyst Society, and it's my pleasure to welcome you to Delta's interim results presentation this morning. On behalf of the Society, I'd like to thank Sandile and the board for hosting the Society this morning again and taking the time to run us through the results and obviously the future strategic direction of the company. The presentation is being webcast, so also if you can just please have your cell phones put on to silent. And now I'll hand over to Sandile. Thank you very much.
Thanks, Gareth. Cheers. Thanks, Gareth. Thank you. Good morning, everyone. Thank you very much for joining us this morning. I think, let me just take you through here. I think we know what we'll get into the results now, but we normally just like to put up this introductory slide just to recap particularly for new shareholders that recently joined Delta or invested in Delta after we're listed. I think historically we've basically always been a sovereign fund when we listed. We listed with 2.1 billion rand worth of assets. And we've basically grown significantly. We've taken the last 6 months of this year to really focus on inward focus and really try and sweat the assets. We've been very acquisitive since listing, as most of you may or may not know. And I think the results that we're presenting today are very solid sets of results given the current trading environment. I think there's a lot of talk politically. Obviously, we've had a few fund managers comment around state-owned enterprises and so forth, and how that impacts a fund like Delta. I think from where we sit, the business strategy and the fundamentals of the business still are very much intact. We find that for property or lease accommodation is very much core to providing services from government. So for one reason or another, I think as we've been mentioning at the 5 previous results presentations, the government still pays. We've had no challenges in terms of collecting our rentals, and touch wood may continue. I think despite the tough trading economic environment, we did see that. The finance minister is suggesting that the economy is going to be growing at 0.5%. Fortunately, most of our income is locked in terms of leases, contractual agreements, and they continue to honor those. What is becoming very key for us is, as we've mentioned in the past, is how we maintain our buildings, where we buy in the right nodes. It's about us understanding where government needs to be to provide its services in the different nodes that we're talking about. And I think Otis, the new Chief Operating Officer, will give you a very detailed nodal presentation in terms of which is publicly available information, where government has indicated in the different locations where they need to be. And part of the acquisitions that we've bought, you will see that they've actually been concentrated in some of those key nodes. I think if I may just go ahead, you will see that on our revenues historically have been sitting about at a comparable period. Historically we used to sit at about 71% of our revenues has come from sovereign or government tenanted assets. Post the acquisition, that has gone up slightly to 76.3%. We also have started our disposal program of 1.4 billion rand of non-core assets, which were predominantly non-government and retail assets, which are smaller retail, where we found that we were not being competitive. So our exposure in terms of our sovereign underpin has then gone up, which is actually very much in line with our strategy. We had a strategy about 2 months ago just to review a strategy review with the board, and the board reaffirmed that despite where the economy is going, that definitely the sovereign underpinned assets is definitely where Delta will stay, and Delta will still try and be the predominant landlord to sovereign and government tenanted assets going forward. Being in the sovereign underpin space, I think our BE rating is very, very important, particularly going forward with the new BE codes. That is going to become quite important that we maintain our level 2 that we currently have, and I think we've made great strides with regards to procurement. I think ownership in terms of how mandated ownership in terms of PRC and the likes is being treated in the codes is going to have a serious impact in terms of our scorecard. We are busy basically getting our new BE scorecard, our new BE rating issued, and we very much hope that we will maintain those levels of level 2, which becomes key, because as again you will see later in the slide, is that finally Department of Public Works has basically undertaken a roadshow in terms of communicating how their procurement of leasing, which I think has been in the doldrums probably for the better part of last financial year or the last 2 years, given the dispensation, is now basically starting to pick up, I think, which is great news for a stock like Delta going into the second half of this year. Our market cap is sitting at 5.3 billion rand at full year in February. That's gone up significantly from the 3.5 billion rand that we were sitting at. I think there's a couple of influential issues there that has gone in there. I think obviously, as most of you know, is that property as by its nature is very much moves in correlation or in contrary to sovereign bonds. And obviously those bonds have been moving up and down, and obviously the property sector by its nature has been impacted by that. Second to that is, I think we had a very, very good pre-close discussion with our shareholders, where we gave them assurance in terms of the work that the management team has basically been undertaking, and that work continues. I think you will see, hopefully through the numbers, and we've tried to improve even more than on our disclosures from our last the reporting period. Our key nodes continue to be Pretoria. Pretoria, just for those of you that maybe are new to South Africa, is the administrative headquarters of government in South Africa, and most of the government department headquarters actually are based in Pretoria. So that's why Pretoria is a very, very key node for us. That's where we find big chunky assets. I think we'll tell you, the rationale behind this number here. We've consistently, ever since listing, tried to maintain 100 million rand average value per property, because our belief is that the bigger the asset, the more difficult for our tenants it is to move. It is very difficult for 40 or 41 or 50,000 square meter tenants to move within CBDs once they are in your building. So it acts as a defensive strategy from ourselves. So part of the disposal assets that we've disposed are assets that fall below that 100 million rand value per property, which is quite strategic. As I've already mentioned, our assets under management, including Mara Delta, is now sitting at 11.8 billion. That's quite a mean feat, considering that just over 3.5 years ago we were sitting with 2.1 billion rand worth of assets. So I think the challenge going forward, and I think we will continue to brief you, is how we're managing these assets and the rationale and why we basically have bought all of these properties, and have we been buying in the right nodes. Just some key highlights on some of the history I've already mentioned. We were listed in November 2012 with 2.1 billion rand worth of assets. We then, in August 2013, launched our DMTN program of 2 billion rand, which we have used to great effect, obviously to lower our cost of debt. But of late, I think this market is, particularly for small caps like Delta, I think liquidity has dried up somewhat, and has become more and more difficult. I think earlier in the year we settled some expiring GMTM program debt of 100 million rand, which we did mention at full year results. And Shanil will give more color in terms of what the strides we've made with regards to some of the expiring GMTM debt that is expiring in December this year. I think we've made great strides in that regard, and I think that is something that we'll use as and when possible to obviously try and counter the cost of debt that we receive from traditional debt providers, being banks. In 2014, we've mentioned we launched Mara Delta, or at the time it was called Delta International. That investment is basically an Africa focus, which gives us diversification from our sovereign exposure, and I'll touch on that later on in the presentation as well, in terms of what our strategy is there and what we see coming out of Mara Delta going forward, given that it's a dollar stock, and I think they've been very aggressive in their growth projection, and I think we appreciate the distribution that we get from there. Obviously, the management team there we know very well. They are led by the previous COO and CFO of Mara, of Delta, and I think we've got great expectations from that management team there. A key focus on these results has been around our balance sheet, and particularly given that there's talk of sovereign downgrades in terms of rating from rating agencies. Obviously, being a sovereign underpinned fund, that will have a huge impact in terms of our cost of debt going forward. So we've placed a lot of reliance and a lot of pressure on ourselves to make sure that we are within manageable debt levels. And I think at 41% gearing, I think is a great achievement from where we were at year end. With regards to actually the actual highlights for the period, our distribution growth that the board has approved is 7.1% on a comparable period from last year. I think given the current economic environment, I think this is a very, very solid number. I think it's sustainable from a quality of earnings perspective. What we have done, the board took a decision yesterday, given the ever tightening economic environment. If investors do recall that at the beginning of the financial year, we had given a guidance of distribution growth of between 7% and 8%. We've narrowed that guidance even more as we get more visibility in terms of our numbers going forward. So our guidance now is basically sitting between 7% and 7.5%, basically taking a slightly more conservative view. And I think the 7.1% speaks to that, is that we are still well within that range, and I think it's a great achievement to ourselves and certainly the management team going forward. We still basically are very much in line in achieving that distribution growth. Which as I've already mentioned, gearing has been a major focus for ourselves. At this time last year, we were sitting at 49.9%. At year end, we were sitting at 47.2%. So to get the gearing down to 41% has been a major achievement. It's been a major task in making sure that costs are maintained. We are refinancing some of our debt, and obviously making sure that we are basically within our 40% target that we had communicated, or the 40.84% that we had basically had given forecast towards the end of this financial year. And I think Shanil will give more color with that regard. This is a new area that we've never really reported on before in terms of on a like-for-like on the core portfolio pre the acquisitions. So the core portfolio prior to acquisitions has grown by 5.2%, which I think, given that we are achieving escalations of 7.1%, I think is very, very good. Given again that it's been very, very challenging. You would have read or listened to the Minister of Finance that government is obviously in a serious belt tightening environment, and obviously I think as responsible service providers to government, I think we have to take the lead from where they are going. What is pleasing for us is that the pain has not been as much as we've anticipated. I think you will see from the exit rentals and what we are renewing rentals going forward. I think the revisions that we're seeing are very, very manageable, and I think we're actually pleased with the budgeting process. That I think taking a conservative stance has actually helped us manage our buildings and our budget a lot more than probably historically that we would have done. So I think we'll give more flesh in terms of what those revisions have been, and I must point out that they actually have not been that bad at all, given the current challenges. Our vacancies, which is sitting here, I think has been really great, and they've been maintained. I think we were sitting at 9% at full year at Feb 2016. So they've ticked up by 0.2, and this is still better than the SAPOA average of 10.5%. And again, I think this is the nature of the defensive nature of the portfolio that we have. We've always said, yes, we are an office fund, but the type of tenants that we do have tend to be very sticky. I think if you cast your mind back, whether it's police stations or magistrate courts and so forth, those type of tenants don't generally move around a lot. And those are the type of tenants that Delta is basically targeting. And I think, as I've already communicated before, is that a fund like Delta, I think, given the current economic environment and probably going forward, should really be performing and beating the sector average, particularly from a distribution perspective, given our gearing levels, and given that our tenants generally, even though they basically do take time to renew on expired leases and so forth, but they still continue to pay, which I think is something that we've been trying to manage. What has been coming through, and basically we did two major acquisitions last year, being the redefined government portfolio and the auto-touch portfolio. There's been major relet. I think we've renewed some 60,000 square meters of GLA and signed up 10,000 of new leasing space, which is actually the most that we've actually ever done since we listed. So we've basically signed up 70,000 square meters of renewals and new leases in the 6 months. Excuse me. I think shareholders will remember that we did say that at year end this year we had 200,000 square meters of GLA that was coming up for renewal. I think there's a lot of discussions that are continuing, and a lot of those renewals are actually at a very advanced stage. And I think by year end, I think we probably would have come back with a far higher number than the 70,000 square meters that we are talking about now. I think a lot will depend, obviously, on what Otis will share with you in terms of the timelines that we've been given by DPW through their PMTE unit in terms of when they expect those leases to roll out. The most exciting thing coming out of those roadshows for us is that long-term leases are definitely back. They have reconfirmed, which is what we've been telling the market, is that the 3-year dispensations that Treasury had given was never really a policy that DPW had taken. Rather, it was more to sort out backlog. I think DPW is getting a handle on their backlogs, and I think for the first time now, along with Treasury, basically are looking forward in terms of what extra savings they can get going forward by signing longer term leases and probably getting landlords to maybe play within a certain band in certain nodes by offering longer term leases. I think as a fund, we've always said, I think if our tenants are prepared to give us security of a longer term lease, I think that will definitely bring down the cost of maintaining those buildings as the value based on the underpinning cash flows from those buildings on a 9-year, 11-month lease, was, for an example, or a 7-year, is far better than getting a 2 or a 3-year lease, which allows us to actually invest more into our capex regime. As we've mentioned, when we did the redefine and AutoTouch transaction, we basically are planning to spend about 600 million rands worth of capex over the next 3 years. That is subject to us renewing those leases. And I think we'll obviously give more color to that as well when Otis gives his presentation in the operation leg of that. Given the two recent transactions that we've mentioned, which were done just before year end last year, that has taken to our GLA that we manage to just over 1 million square meters, which is very, very big. And I think the rationale from our side is that ultimately government, like any solid tenant, the property fundamentals will come into play. I think where we've started seeing some benefit in terms of some of our acquisitions is that in the nodes that we play in, particularly if you look at Durban and I think Pretoria, where there has been some tenants coming around, we basically have been able to put 2 or 3 buildings up as possible properties that government could let. And because of the amount of capex, we tend to spend more capex than any of our competitors that play in these nodes. I think is a big competitive advantage that Delta has in the CBDs that in the nodes that we play in, basically. I think key to our cost of debt is obviously our credit rating. And I think we're very pleased that GCR, who's our credit rating agency, has reaffirmed our corporate rating of BBB+. And on our DCM secured bond, I think that's an A+. And I think that rating has been maintained by GCR going forward. But I think maybe if I'll ask Chanel to give more meat to on the numbers in terms of the breakdown in terms of core portfolio, how the acquisitions have impacted the distribution, and what our plans are going forward in terms of our fixes going forward. Chanel, thanks.
Thank you, Sandile. And I think a warm welcome to ladies and gentlemen in the audience and our attendees on the webcast. I think you would all agree to Sandile's comment earlier on that we are very pleased. I think we've got a solid set of results, 7.1% distribution growth in quite a challenging environment, especially the last 6 months. I think the management team of Delta has really accomplished a good set of results. So I think my task this morning is just to take you through some of the highlights and just to give you a bit more color around the finance within the business, what our objectives are, how we are actually achieving against some of our internal objectives. So I think to start off, gearing, Sandile has mentioned that at least 3 or 4 times. I'm also going to be emphasizing it. So I guess, we just what we're trying to communicate is that this is a big strategy in the business. Obviously, our LTV perspective, has got quite a bit of effect for us, especially from a funding perspective. Taking into account our facilities that we're going to be refinancing, renewing. So I guess a lot of effort is being put into this. We must also acknowledge, I think, the transactions that were done fairly strategically, especially the redefined transaction, went a long way to help us bring this LTV ratio down. That benefited us just over 5%. But I think beyond that, as a management team, we have communicated to the market the disposal program that we've had at year end, which was 1.4 billion rand. So I guess that is a portfolio of non-core assets, which management has identified, and I think we're making good strides in getting those disposals, in signing up those sale agreements, and obviously the disposal proceeds. As that flows into the business, we will utilize that. It'll be a balancing act between our gearing levels and also with regards to spending on yield accretive capex. So at year-end results as well, you would remember we had a pro forma balance sheet that we put out. Our target to full year Feb 17 was 40.8%, as quoted from the presentation. 6 months, we're sitting at 41%. So we're pretty confident that we would surpass that target that we set for ourselves at year-end. Another big milestone for us, I think, again, comes to the debt in the business. We've refinanced or settled 832 million rand worth of debt in the last 6 months. And I think just to break that down further, 688 million rand of that was bank facilities that we effectively refinanced. Commercial paper, we had three commercial papers, totaling 164 million rand, which we settled in cash. So I guess, from a refinance perspective, I think we're progressing fairly well. To year end, we've got a big secured note in the DMTN portfolio of about 462 million, which matures on the 9th of December. So currently, we're busy working on trying to get that refinanced. We are also in the process of restructuring our DMTN program. We're trying to create a lot more flexibility in that program so that we afford the opportunity to have multiple participants. So from your banks to the DMTN market, and it just gives us a lot more flexibility in terms of moving assets around or trying to bolster up different security portfolios. So on the 462, I think we are making good progress, and we're obviously hoping to get that over the line. To year end, there's a few bank facilities that remain of about just under 140 odd million rand, which we are fairly confident as well that we would refinance and get over the line. I think with the refinance, obviously, one of the biggest risks is always the rates in terms of how we're refinancing this debt. So I guess, fortunately for us, we haven't seen the needle move too hard, and I guess that speaks again to, if you look at our weighted average cost of debt. At financial year end, it was 8.75%. We're up to 9%. So a big part of that as well has been the rate increases that we've experienced during the period. And the refinance, we're cognizant about the rates, and we're taking a bit of a shorter-term view with the hope that the economic environment improves. So that will then afford us greater flexibility down the line to restructure this once pricing is a lot more favorable in our space. Interest cover ratio at 2.38. I think that's fairly static since financial year end. So I guess this is also quite a key ratio for us, especially with the level of debt in the business. One of our key covenants across our financier pool is maintaining a ratio of at least 2. So I think we're fairly happy with the 2.38 cover we have at this stage. And I think just to mention is that we post the half year, we received some dividends from Mara Delta. So factoring in the dividend into this interest cover ratio improves that to 2.44. So that's where we stand at this stage. Net cost to income ratio, 12.2 at year end, down to 10.2%. I guess for those that attended the year end presentation would remember that our 12.2 did tick up slightly from our financial year end August 15. One of the reasons for that is that the acquisitions that we did, and I think we were fairly vocal in that, we had to take control of those portfolios, and we had to get management of that portfolio to try and obviously better manage the operations of those portfolios. So I think the 10.2 speaks to what we've actually communicated to the market. We've got a much better hold on the portfolio. In addition to that, there have been certain better than expected recoveries versus the Delta portfolio. So that's also given us a bit of a benefit in terms of the net cost to income ratio. Debt levels, our fixing of debt, slightly up from financial year end. I guess this for us is also really key because I think investors appreciate the fact that with regards to the level of earnings, you do have some security against your risk, obviously against the finance risk. And again, with the fixing of debt, pricing as well, we're very cognizant of pricing. So there was quite a down cycle, when there was quite a bit of rally in the rates, and we took that opportunity to fix a further 360 million rand between year-end and this interim period. We do have another big swap contract that's coming up for expiry in December, and we're obviously going to try and make sure that, depending on pricing, to try and keep this metric obviously above the 80% mark. Property operating margin, I think this for us also is quite a highlight, considering that we've obviously had quite a big amount of acquisition that has come into the portfolio. Obviously with inflation and the fact that we still, from an operating expenses perspective, from an OPEX perspective, I think we're still managing that fairly well to have maintained this ratio with all of the acquisitions that have come on board, which generally takes a bit more time to bed and settle down. So I guess, the operating margin, the cost to income ratio effectively speak to each other. I think on the financial review side of things, if you look at our revenue growth, it's just over 30% worth of revenue growth that we've had in the business. A big part of that has come through from our acquisitions. So I think that's benefited the business quite substantially, but our existing portfolio as well. And I think as Sandile alluded to, the 5.2% growth, like-for-like growth that he's highlighted, which was on a net income basis. From a revenue perspective, the like-for-like growth has been just over 6% in the portfolio. So I think we've accomplished and we've achieved pretty well to have that level of growth. Finance costs, I think if you look at the movement there, that obviously correlates with the rising interest rate environment that we've experienced during the period, almost 100 basis points between September 15 last year and August 16 and August 16 now at interim. That combined with the fact that we've increased the debt levels in the business. I mean, there was about 500 million rand worth of debt that was taken on between half year last year to this half year, and that's obviously in relation to the acquisitions that we've done in the business as well. From a year-end perspective, our debt levels didn't move too significantly. So, I mean, that speaks to the corporate activity and more with regards to the acquisitions in the business that hasn't really, we haven't done anything significantly during this period. So our long-term liabilities have remained fairly flat from year-end. Cost to income, I think we've covered that. Investment property as well. You would see the movements. Again, a big part of that is the acquisitions, the redefined portfolio. That was 1.255 billion on its own. So I think that contributed quite significantly. We have had a few other smaller acquisitions. So I guess to reconcile that number, the biggest part is that 1.255 billion. Listed securities, Mara Delta. I think that investment, we continue to earn distribution. And I think like Sandile mentioned, 7% growth, which is very, very attractive. The initiative that we've also got in play at this stage is to migrate our shareholding. Mara Delta is dual listed on the SEM and the JSE. So currently our shareholding is on the JSE. We've got Reserve Bank approval to move that across to the SEM. We're expecting quite a nice arbitrage benefit of about 120 million rand. So that's the initiative, and I guess that will also give us a bit of benefit. We expect about 0.5% that will benefit the LTV calculation as well. Borrowings, I think like I mentioned, the 500 million movement between H1 to H1, and as you can see from year end, it's been fairly static. Interest cover, I think the weighted average interest rate that I've spoken to as well, has ticked up slightly again. That speaks to the rising interest rate and obviously with regards to some of the facilities that we've refinanced during the period. The debt expiry, so it's ticked down. I think the passage of time has obviously ticked it down slightly. And I guess this is another matrix for us that, going forward, we obviously want to ensure that we improve this ratio. I think it's important for us to have this in the 2.5 to 3 year mark. I think that's the target that we've got internally. And I guess that will lead on to what Otis will be speaking on later on regarding some of the longer term lease renewals and how we actually term out some of those facilities. Debt fixed expiry as well, that's remained fairly constant. It hasn't actually, because with the passage of time, it's decreased. And obviously some of the swap contracts that we've done in this financial year, 360 million, has been termed out with good pricing. So on a 4 and 5 year basis. So that has actually helped us to pick up this ratio. Fixes, I've spoken about the fixes. Net asset value, 1061 to 986. I think just to highlight here, the biggest movement downward was, again, the redefined transaction that we did. For those of you that may remember, the transaction was done, it was a full share issuance transaction. It was done at 7.75 Rand, which was a discount to NAV. So that's effectively where you're seeing a bit of the dilution coming in here. But there again, I think the transaction that was approved at 7.75, there's a lot of upside opportunity for Delta, buying the portfolio with shorter term leases. And I think from a management perspective, the objective is obviously to renew that on a longer term basis and get the fair value uptick, which obviously will then improve on our net asset value calculation. The distributable income statement, I think, leads on from the income statement. So I think just to highlight, if the net property income, which Sandile has spoken about, there again, like Sandile mentioned, the like-for-like is about 5.2%, which I think we are very, very pleased with. Administrative expenses has ticked up, but there again, I think it speaks to the size of the portfolio. So with a growing portfolio, obviously you're going to have costs that tick up accordingly, or that's closely correlated, and that effectively has resulted in a 4 million rand increase. Realized foreign exchange is a small number, but I think just to give some content here, we do have a foreign loan with the Bank of China. So effectively that interest payment happens twice a year. So this is just the realized portion on the last interest payment that was actually done. Net finance costs, I think I've covered that in the previous slide as well. Obviously, the net offsets income that we've earned. So if you look at the previous slide, you've got a number of 228, which is the pure finance costs. This is the net. So we've got interest income of about 13 million. And, we're earning interest. We've got some guarantees, cash guarantees in place that we are earning interest on. There's some loans that we have where we are earning interest as well. So that effectively is the set-off between the finance costs that reconciles to the net finance costs. Dividend received from Mara Delta, that's ticked up nicely as well. I think 7% distribution from their perspective, and I think we're fairly happy with the investment at this stage. It's giving us, like Sandile mentioned, the diversification within our portfolio. And in terms of their pipeline and their growth aspirations, I think we're fairly excited looking forward. So that's what we've actually achieved. Sundry income, a very small number. This is bad debts in the business that we've recovered. So obviously was written off and that we've recovered, a very small number. So I guess in summation, that obviously gives us the distributable income for the period, 313 million rands, which is a 7.1% growth on the prior period, comparable period. I think just to highlight, if you look at the number of shares, and I think this is a new calculation we've done this year as well, there is a differential because of the redefined acquisition. So the redefined acquisition that took place, the majority of the share issuance took place during the month of April. So effectively there was a period where they were not entitled to any of the distribution for the period. And historically it would have been classified under antecedent interest, which we would have built into the distribution. We've now taken the view where we've calculated the shares that are not entitled to do distribution. So it just benefits us from a cash flow perspective. And effectively, that's the reconciliation between the 710 and 681. There's about 29 million shares that do not qualify for distribution purely because of the fact that this happened in April and not at the start of the financial year. Distribution per share, 45.93 versus 42.89. That's our 7.1% growth. I think this slide is just to highlight and just to show that from a Delta perspective, it's always good to see an upward trajectory with regards to distributions, and we obviously hoping to keep this momentum growing along the same trajectory that you see up here on the slide. I think this is a new slide. We haven't historically included the distributable earnings bridge. So I think here as well, it just gives you a bit more color into our H1 of 232 and how we've actually landed up at our 313 million. So you will see the parts in between, the existing portfolio, the acquisitions, the additional dividends from Mara Delta, the reduction. Obviously, we didn't have any antecedent this financial year. Finance costs have gone up by 34 million. You've got admin costs that I've discussed as well, just under 5 million. And obviously other income, which this year was only at 15,000, being the bad debts that we recovered. So this bridge actually gives you, reconciles for you how we land up to our H1 distribution from last year, and how the business effectively has been progressing from a operational perspective and financial perspective. Like for like, I think I've spoken about this already. If you look at the growth in the existing portfolio, 30.9%, and obviously 5.2% is the like-for-like increase. I think just to explain this a bit more in detail, you'll see we've time-weighted, which has reduced it slightly. You would remember the the Free State portfolio that we actually acquired was effective in the last financial year. So in our H1 period for last year, that portfolio was in for 3 months. So effectively for this financial year, it's been for the full 6-month period, and a lot of this weighting comes out of that Free State portfolio. There have been other acquisitions, a lot smaller in number, but majority of that is from the Georgia, where we've obviously time-weighted to get the growth in our core portfolio that we had last year. Statement of financial position, I think just to highlight, we've spoken about quite a few of these numbers. With regards to the 11.8 billion that Sandile has mentioned, with regards to our assets under management, that's effectively our 10 billion rand investment property. We've got this 1.2 billion assets held for sale, and we've got our shareholding in Mara Delta. So it is an associate, so this is actually equity accounted, implying that this is just costs and profits. In our assets under management calculation, or in our LTV calculation, we obviously take into account the market value based on the JSE at this stage, and future looking will be the value trading of the SEM. Then you've got non-current assets. We've got some derivative financial instruments in there. We've got some property, plant, and equipment in the business, which are the smaller numbers. Current assets, I think the big numbers in there, you've got your debtors, you've got your trade and other receivables effectively. We've got some loans receivable, and we've got cash. At this stage here, we've got a cash balance of about 134 million. That's in the business, of which 120 million is in a cash guarantee, and 14 million is effectively the free cash that we've had in our bank account at the interim reporting period. Equity, you would see the movement there again speaks to the share issuance that we've done on the acquisitions. Non-current liabilities, this is majority of this is the debt levels in the business. A portion of the current liabilities is our trade and other payables, which is a much smaller number of the 1.2 billion. The net asset value, 986, like we've disclosed previously. Another new slide, the NAV bridge. So obviously in terms of the slide, the methodology is exactly the same as the distributable earnings bridge that I've put up earlier on. 1061, 986. And I guess here you would actually see, if you look at the assets that we acquired, that was the benefit to NAV, 180. 265, however, was the dilution, and that again speaks to the discount to NAV that the shares were actually issued at. Then you've obviously got your normal operations, revaluation of some of the financial instruments, Forex. That's the contribution from our associate, Mara Delta. And obviously the dividends, this is the year-end dividend that was paid during this H1 period. And obviously the disposals. At half-year end of our disposals list, we've transferred and realized a disposal on the Tembisa Megamart property. So that effectively speaks to the disposal that's been done here. And I guess, from a debt summary perspective, 5 billion rand worth of debt in the business. I think this just gives you the complexion of that 5 billion. We've got bank facilities floating, we've got fixed, we've got revolvers, DMTN 587. I think I've spoken about that, the big part of 462 that expires in December, and there's a portion in October 17 next year as well, of about 125 million. Vendor loan, this is an acquisition that we did last year, which we will settle in cash in December. Here again, I think just to give you a bit more color around the fixes. Fixed bank facilities, 796 million. Swap contracts, that's where the biggest amount of fixing lies in, 2.5 billion. And we've got some cross-currency swaps that are obviously giving us quite a nice benefit with regards to our weighted average cost of debt as well. Okay, we've covered the the fixed ratios, the interest cover, loan to value. And I guess this is just a nicer looking way to just give you a picture around the debt summary, the previous slide. So I guess looking at it just to show you the sources of debt, the way we've got it, the diversification thereof, the debt classification between the different facilities, the fixed breakdown, and basically our financier split. So I think we're fairly well multi-banked at this stage, and I think that's what this slide demonstrates. Debt expiry profile. I guess if you look at it, there's quite a bit of work that goes into the next 3 years. Within the immediate financial year, we've done quite a bit. So you would see the DMTN, that's the biggest number in our lives at this stage, which is the 462. We do have quite a big swap, interest rate swap contract that expires in December, which obviously market dependent and rates, we would look to obviously put another swap in place to keep our fixes above the 80% mark. Floating facilities, there's just under, I think it's about 140 or 160 odd million that's due in January and February. We're fairly confident to have that refinanced. And this is the 15 million vendor loan that I highlighted in the previous slide. So I guess next year, again, from a bank facility perspective, just over 800 odd million, that's the swap contracts. So I guess Otis is going to give us a bit more color with regards to the DPW leasing policy, and I think we're fairly excited about that, the longer term leases. So all of that is obviously going to give us quite a bit of impetus when it comes to renewing and refinancing some of these facilities that we have up here. So on the debt commentary, I think, I've already touched on quite a few of these of the aspects. More around the cost of debt, the way that's actually increased, and the pricing that we see in the market. The liquidity in the debt capital market, I think for funds our size, as Sandile has mentioned, has become a bit more stringent and it's a lot more scarcer for us at this stage. But I think, like we've mentioned, I think these are our highlights regarding the refinancing, the LTVs, the fixes. So I guess it's all of the financial metrics that we're obviously keeping our finger on the pulse and trying to ensure, or we will ensure, that we have this at levels that are obviously conducive to a good and healthy balance sheet in the business and a environment going forward that can support the capital requirements that's coming in the business over the next 3.5 to 4 years. Okay, thank you very much, and I hand over to Otis.
Good morning, ladies and gentlemen, and welcome to our results. My two learned colleagues have set the stage for me. I think we all know we're in a tough economic environment. It's even tougher in the government space. But in spite of all the toughness, I'm here to tell you what we as a fund are doing to deal with the tough economic environment. Delta has grown from listing with 20 properties in November 2012. In about 5 days' time, November 2, we'll be turning 4. The portfolio has grown to 115 properties. We're proud of the milestone we've achieved in our square meterage, where we're sitting at 1 million square meters in just under 4 years. Our vacancies are sitting at 9.2, and as Sandile alluded to earlier, that's within the SAPOA sector average. If you take out the properties that we've got for disposal, that 9.2 reduces to 8%. So we're not too concerned with the vacancy levels at this stage. The average rentals that we're getting from, sorry, Shinada. Okay. The rentals that we're achieving from our average rentals about 110 rand a square meter. That is within the market norms. Coming from government, there's a big drive to bring rentals down. They're bringing them down to market-related rentals. Market-related rentals range from 95 to about 120 rand a square meter, and we're well within that norm at the current 110. There are some landlords who are sitting on high rentals of about 160, 170 in the Pretoria node, and those are the guys that will really feel the measures to drive down rentals. In spite of the noise coming from government with regards to the second Treasury dispensation, where lease renewals escalations have been kept at 5.5%, we've managed to achieve an average escalation of 7.1% going forward. The two big acquisitions that we did, being the Redefine and the Free State portfolio, were predominantly made up of month-to-month leases and lease agreements expiring in March 31, which were renewed in terms of the second Treasury dispensation. Those have had the effect of bringing our lease profile to about 2 years, our weighted average lease expiry to about 2 years at the moment. But we are aware that government and National Treasury are working on a new leasing policy whereby they're bringing back long-term leases for the empowered companies. For a company like Delta, which is 100% Menco, we're expecting to get 5-year leases to about 9-11-year leases. That slide just goes to reinforce the statement that we are unapologetically a government fund. At last time around, we were sitting at 71%. With the new acquisitions, we're sitting at 76%. 76% of our income comes from government. So when government sneezes, we feel we catch the cold. And whatever noise happens in the political system, people rightly or wrongly perceive that Delta is affected by that. This is a new slide that we brought through for the first time around. This slide seeks to break down the 4 spheres of government. 76% of our income comes from government. The makeup of that is that 40% of the income comes from National Department of Public Works. National Department of Public Works is the one where there's the second Treasury dispensation, the 3-year maximum lease and the 5.5% escalation. I think when people hear that 5.5%, they take it wrongly that the whole Delta portfolio is covered by that 5.5% escalation. It only affects 40% of our income, and that is coming to an end. 31 March, we've been assured there will be no more Treasury dispensations coming back up. We'll be getting long-term leases going forward. 20% of our income comes from the provincial government departments. There, they run their own leasing negotiations. We've successfully managed to get 5-year leases at rentals of about 129 rand a square meter. We've got escalations of 7% to 8%, so we're not covered by that dispensation. On a state-owned enterprise, which covers things like your SARS, your ESCOMs, we're getting long-term leases. We've just renewed a lease, Johannesburg Water, in one of the buildings that we acquired from Redefine, over 4 years at 8% escalations. And then on the local government, it makes up about 5% of our income. We deal with the rated metros, which is your eThekwini, your Cape Town Metro, and your Tshwane Metros, the bigger metros. There, we're in discussions with eThekwini and Tshwane to get 9-11-year leases, which will be backed by CAPEX, and on the back of those, we'll then do the CAPEX. Government has been in shambles, but they've been cleaning up their act. They've been working on it. They put together a specialist unit called PMTE, which is a property management trading entity. That entity is led by Paul Seroti, who is a CA. Paul has correctly staffed the department with property professionals. You've got people like Mandla Sitole, who's studying for his master's in property. You've got people like Moses Sekoko, who's been in the property industry for 20, 25 years. So we're dealing with property professionals going forward. The department has been cleaning up its act. They've been told us that the second Treasury dispensations are coming to an end. They will not be bringing those back. Those were brought just to clear the backlog of the leases that came up when there was the corruption issues in 2010 and all the other issues that happened prior to that. They are rolling out a new leasing strategy. They've roped in Treasury, and they've had roadshows where they've called all the top landlords during October, and we are aware that they'll be engaging other role players like SAPOA, like SABIP, which is a black property professionals. They're also talking to the financial institutions. We know that around about the 4th of November, they'll be meeting the CEOs of the banks and the heads of the property divisions to explain the new leasing framework that they are bringing back. But the outcomes of the leasing policy framework is that long-term leases are definitely back. They will look at implementing the sliding scale that they had in the past. If you're a 100% empowered company, you'll get a 9-11. If you're 50% empowered, you're looking at a 5-year. For a listed entity like Delta and the Rebosis and the extensions that have 100% Mancos, we're expecting to get 7-year leases, 9-year leases, and 5-year leases. Those are coming back. One of the things that government wants to do is they want to do pay market-related rentals. There are some unscrupulous landlords out there who are charging government rentals that are way above market. In Pretoria, there's landlords getting 190 rand a square meter. The intention is to bring down those rentals, but to market-related rentals. Delta as a fund, when we acquired our properties, we top-sliced the rentals, and in terms of our budgets, we've already factored in the pain. So you'll see when you get to the later slides that even though there's reversions, it's not as bad as how people anticipate it to be. And the other good thing coming from the roadshows that we've attended is that they're bringing an automated payment system. Government pays rent. They may pay slightly late, but they always pay. Delta as a fund does not have much in terms of government arrears. The only time we have arrears is when there's a change in vendor. For instance, when we bought the redefined portfolio, when we're changing the vendor from redefined to Delta, that's where you sort of have delays, but they always pay. And previously, when leases expired, government deemed continued payment of rentals as wasteful expenditure. We've now got to a point where we've got a concession out of them, that even when a lease expires, they'll continue paying rentals in line with the recently expired lease. And in fact, we are lobbying that where the lease is expired, we put pressure on them and get them to escalate in terms of the escalation in the expired lease agreement. So as I said again, the PMTE is correctly staffed. We're negotiating with property professionals, people who understand that for you to carry out major capex on a building and provide quality accommodation, you need to have a long-term lease. In terms of the outcomes of the roadshows with DPW, we believe that we're well geared to benefit from the long-term leases that are coming up. We've got 100% Menco. We're expecting nothing less than the 9-year leases going forward. Our buildings are well located, and I believe our rentals are well within the range where we can continue benefiting from DPW. In spite of the tough economic environment, we've managed to successfully renew 60,000 square meters. And as Sandile alluded earlier, it's the best we've done as a fund. The rentals that our expiry rentals were on average 112 rand a square meter, and we've managed to renew at 103. The reversion is only 7%, which is not too bad in our view. And then the next slide just breaks down the breakdown of the actual 60,000 square meters, just to show where it's coming from. You'll see in Nelspruit, we managed to renew about 10 leases. The reversion there is quite significant, but if you know our Nelspruit portfolio, it's made up predominantly of the army barracks or buildings with defense in them. So it's not your office buildings where that reversion is being seen. If you look at the 4 leases we've renewed, the reversion on government buildings, your B-grade buildings, is not too bad. It's 11% on the 4 buildings that we've renewed. On a provincial basis, you can see we're still managing to achieve rentals of 110 rand a square meter. With the state enterprises, we're getting rentals of about 95 rand a square meter. We've got a mammoth task ahead of us. In terms of the rollout of the new leasing policy, DPW have said that they meet in the banks, obviously, during the month of November, and then they're going to issue an RFP where all the landlords will respond with their monthly leases and their vacant buildings, and they're going to put that onto a database. Once they put that onto a database, landlords will then respond with what rentals they believe is market related for the accommodation that they're offering. And then from that database, DPW will then source accommodation for the various departments. So we have about 233,000 square meters that is expiring between now and February 2017. It is a big number, but we are not too concerned about it because we've already started engaging DPW in terms of these renewals. And they've said to us, come April, when they roll out the new leasing policy, they're going to target the top 20 landlords first and call us in, and we'll get our renewals done en masse. And we believe that with the new long-term leases in place, those things will improve. What we've done is we've already factored in the pain in terms of responding to the message coming from the finance minister, where they obviously are looking to get better bang for accommodation. And we've already started factoring in reduced rentals. If you look at the leases that are coming up on the 233 square meters, our weighted proposed lease is 104 rand a square meter. Our current expiry rentals are 109. The reversion, once again, is negative, but not too negative at 4%. It's something that we think we can live with. In March, why we've put March at the bottom is that the second Treasury dispensation expires 31 March. And so we've elected to reflect and show you how many more leases are expiring in that period. So if you look at the ones expiring 27, February 28 and March 31, we're looking at 300,000 square meters. And again, if you look at the bottom, the reversion, overall reversion, there's a positive uptick on the renewal at 1.4%. That's just a graphic illustration of the previous slide. This slide shows again what the CEO alluded to earlier on, that Gauteng remains our biggest node, and KwaZulu-Natal is the second biggest node where we are. We're in the CBDs there, we control, we have something akin to a monopoly in those areas. The next slide is a slide that comes from government themselves. This is a slide of the areas in Pretoria where government wants to be in. The areas highlighted in yellow is where government deems to be the government precinct. And all our buildings that we own in Pretoria CBD are located in this node. The buildings we acquired from Redefine, also in Pretoria, are also located in this node. And in fact, there's a cabinet memo that says that national government departments should all be in that node. This slide shows the buildings, the Pretoria CBD. It's an aerial view of the Pretoria CBD. The buildings circled in yellow are the 9 buildings that Delta currently owns. Of the 1 million square meters in Pretoria, Delta controls about 300,000 at the moment. You can see from that, if you look at the size of the buildings, government needs to be within that precinct, and even if they were to move around, there is not many buildings to move around in. The section you see on 18 is the new Pretoria Tshwane Monitoria head office. That's a 2.5 billion head office that the city of Tshwane is building. Number 9 is a building that we acquired from Redefine, Isivuno building, which currently has the city executives sit in that building. We're in discussions in there for that building with the city to sign a 9-year 11 because Monitoria can't house all their requirements. There's a shortage of about 1,500 people. And then we also show some other buildings in the CBD that are currently on the market. Number 11 is a building owned by Encha and Investec. It's currently on the market, and we're considering that building as an acquisition. Number 10 is one of the iconic buildings in Pretoria. It's owned, but it's also on the market in one of the buildings that we're looking at. The next slide shows Durban, and again you can see the Delta buildings are highlighted in yellow. From a visual representation, you can see that Delta is well placed in the Durban CBD. We have 14 buildings in the Durban CBD. And then the next slide shows our properties in Bloemfontein. The Bloemfontein properties are also in line with our strategy to acquire dominant buildings in the CBDs, in the nodes where we know government wants to be in. Admittedly, in Bloemfontein, we're having a bit of challenges on the renewals of the provincial leases. On a national basis, we're pretty comfortable that when the new leasing policy is rolled out, we'll be able to get renewals on those ones. Our strategy going forward, ladies and gentlemen, is to continue being inwardly focused. We want to fill in the vacancies. We've got 300,000 square meters of lease renewals to renew. We're concentrating on that. It's inward focus. But having said that, we'll continue to look out for opportunistic acquisitions that come. We'll only buy, going forward, things of 100 million and above. We won't be buying the small things that we bought when we were growing the fund. and we'll look for buildings that are government buildings in the nodes that we understand, underpinned by long-term leases. In the past 6 months, we've successfully transferred the balance of the redefined portfolio, which is 17 properties. We bought those at a yield, an attractive yield of 13%. The GLA of the redefined portfolio was 200,000 square meters. We've already renewed 10,000 of that, Johannesburg Water, over 4 years. We've got 100,000 square meters of the redefined, predominantly in Pretoria, where we're well advanced in terms of renewals. The redefined portfolio helped with our gearing, as Shanil alluded to earlier. We went for the redefined portfolio because it was at an attractive, accretive yield, and given our strength in getting the leases renewed, as evidenced by the amount that we've done to date, we think it's a good acquisition and that we're well placed to extract maximum value from that portfolio. I've touched on the renewal of 17 Harrison and 113 that we're currently in advanced negotiations. In terms of CAPEX, our CAPEX will largely be dependent on the lease agreements. If you look at eThekwini and you look at Tshwane, we're looking to get 9, 11-year leases. So the CAPEX on those buildings will be underpinned by long-term leases. In terms of disposals, the disposals are going well. Tembisa Mega Mart is transferred. We sold that at a 9% yield. We have 10 assets that are currently well advanced in terms of lodgement, in terms of being on prep and progressing well. The proceeds from the CAPEX, from the disposals, is being allocated to debt reduction and to CAPEX. Touched on CAPEX. We have 3 major CAPEX, 3-tier approach to our CAPEX. The first is we do CAPEX for a defensive basis, where we're trying to maintain our tenants, where we fix the lifts and keep the aircons on, which is the buildings that we buy are predominantly C grade, and that's the opportunity that we see in converting them from C grade to A grade. The next type of tenant installation that we do is where it's tenant installation driven. We've got an example of a building, 2 buildings there where we've done tenant installation CAPEX, and we're in the process of getting long-term leases. Beginning of the year, we had a budget of 294 for CAPEX. We've only spent 107, and it's reflective of the lull in the leasing market at the moment. When we start getting the new leases renewed, we'll then deploy the rest of the 187 million that we've got budgeted. The major CAPEX that we have is 88 Field. That's been on the back of lease agreements coming from NPA and Department of Water. Commission House is a building where we lost a tenant. We then proceeded to start refurbs on it to prepare it for a tenant because the building was well located in Pretoria. We've now secured a tenant. Department of Public Enterprise is in discussions with us to sign a 5-year lease at rentals of 110 rand a square meter. In dealing with the new professionals at Public Works, we're having robust negotiations around the rental. And the new thing that government is doing where you don't agree on rentals, they allow you to appoint a valuer who then gives an opinion, and they've got their own in-house professionals who then debate the rentals. And we're seeing that playing itself out at Commission House. Beacon Hill is a building in King William's Town. We've secured a 5-year lease at 129 rand a square meter. The escalation there is 8%, and on the back of the long-term lease, we're looking to deploy 40 million rand into that building. And then the Isivuno and Shell House are the 2 provincial municipal tenanted buildings, one in Tshwane and one in Durban, where we're discussing 9, 11-year leases. And once we procure those 9, 11s, we'll then deploy that CAPEX that we have. Thank you.
Thanks, Otis. Yeah, I think for those of you that have been following Delta, I think we've tried to give slightly more color as we mature as a fund. And obviously, we are learning and in terms of what our shareholders and investors are obviously looking for. And hopefully the information that we're providing you is pretty key. Just to summarize from my side, and we'll open it up for questions. I did mention that we currently have a 23.9% shareholding in Mara Delta. As Shanil has mentioned, we have Reserve Bank approval to migrate that shareholding from the JSE to the SIM. I think there is quite a nice arbitrage in terms of the valuation in terms of share price that Mara Delta is trading on the JSE vis-a-vis the $1.74 that Mara Delta trades in Mauritius. Granted, liquidity on the SIM is definitely not as much as here on the JSE, but given that we are strategic holders in Mara Delta, I think we would like the value uptick more than the liquidity at this stage. Having said that, I think we are very cognizant of our balance sheet, and I think we are quite clear that going forward we will obviously need to take care of our liquidity situations, depending on in terms of what happens with banks going forward. But at this stage, we definitely are not in a position to follow our rights in terms of Mara Delta's rights issues going forward. And at this stage, we're in discussion with the banks in terms of refinancing. You've seen how much work that is ahead in terms of expiring facilities and cost of debt. And I think we basically are leaving our options open at this stage, even though we do like the investment very, very much. And I think we've got great confidence and faith in the management and the strategy in terms of the rest of Africa, given the low property penetration in terms of listed sector on the rest of the continent. In conclusion, I think you do know that we had a couple of management changes. I think Shanil joined us in December last year. He was with us at full year in terms of presenting the full year results. I think he's made great strides in terms of immersing himself and re-energizing his team to basically focus at the task at hand in terms of strengthening his balance sheet. I think his KPI there is particularly focused towards balance sheet strength going forward, particularly given the headwinds that we anticipate in the market. Otis Shabalala, I think for those of you that don't know, Otis has been with Delta actually since prior to listing, and actually worked very, very closely with Bronwyn, the previous COO, and most of the transactions that were done were actually done with Otis, and I think he's got first-hand experience in basically most of the transactions that were done. So I think it was a natural progression to basically promote Otis from within the company, particularly given the complexity of basically managing sovereign tenanted buildings. I think they are very much relationship driven, and I think those relationships have continued over many years being in the sector. Also, CapEx is a major ticket item going forward. We are very pleased, and I think some of you have met Andries Skuman from our one-on-ones. Andries was a senior director at ACOM. Andries is a QS by nature, and basically we've appointed him as head of our capital projects to look after our projects going forward. And I think he's making sure that the cost of those projects obviously coming within budget and obviously on delivery on time. And I think he did a great job with his team in delivering the CMH refurbishment on time and in working with that team. We also have Sandra Mlina, who also has been with Delta probably also prior to listing. So I think a lot of the guys have been with us for probably better part of 5 years or 10 years. Even prior to listing. So I think there's a lot of IP that sits in the business, particularly related to the relationship with our key tenants. As I've historically maintained that not all of the government relationships sit with one individual. We're certainly not one of those funds where, as a CEO, basically I manage all the relationships. I think our task is way too big for one individual to try and manage. From a sustainability perspective, we try and manage at different spheres. whether it's provincially or local government or national government, it's absolutely important for us that, more than one individual basically can pick up on any issues that we do have. We also have not only enriched the experience in terms of our board, we do have Maralise, who has joined us as a non-executive, and also as the chairman of the investment committee. Maralise was the previous CFO at Texton, and I think she's brought great skills to basically take over from George Da Costa, who obviously, as you would have seen the SENS announcement, who went on to go and manage his own business, and I think he's involved in one or two other listed funds as well. So I think we're very pleased with the expertise that we have at board level. And also operationally, I think we've recently appointed two senior operations asset managers as the portfolio has grown to beef up the back office. It's absolutely imperative that we are able to timeously respond to some of the day-to-day maintenance and management of these portfolios. So I think those have been completed. Going forward, I think significant progress is being made in terms of the balance sheet, as you've heard, and I think we look forward to giving you an update at our full year results next year in terms of the progress that we've made in terms of the balance sheet. The credit rating we've already mentioned, it's done for this year. The refinancing of debt, that continues very, very well, and I think we are very, very close to our funding partners. I do see some of them in the audience there, and thank you very much for your for attending. And I think they are very much as much as we are invested in the business, and I think those relationships continue to be key in getting their buy-in and understanding that the strategy is still very much intact, particularly with the anticipation of the rollout of the long-term leases, as Otis has mentioned. Going forward, it's going to become hopefully a bit easier for Chanel to then negotiate his debt renewals going forward. I think significant progress has been made on the 462 million rand. Chanel has omitted to mention that we have a signed term sheet with the prospective funder, I think, which is very important. We are basically going through a DD process with that particular funder. So I think when we're saying that we've made a long way, we basically have a signed term sheet on the 462, not for the full 62, only for 350 million of that 462. So I think that is great progress, and I think given the trading environment, I think that is pretty good, and I think we look forward in having a successful conclusion as part of that DD process on refinancing that DMTM debt. I think on the disposals, it's going to be key. I think we can certainly use the proceeds from the disposals, particularly to show up our balance sheet, as already mentioned. I think we are basically looking that, I think of the 500 million that Otis, or 562 that Otis mentioned earlier, that is already under agreement, that hopefully that transfers within the next 6 months to make sure that those cash flows come through into the building. So I think that's some information to look forward to going forward. Sovereign risk in terms of leasing, I think, continues to be a key factor. It's one of the key performance areas. I think I'm not going to bore you with reading each bullet point. I think we've been a task to mention that that's a key area for us. I think debt leasing is very, very key. Our strategy is very much intact. I think we're very comfortable with the space that we play in. Yes, it's challenging at times. I think politically, I think Delta is definitely not a political animal. One key thing that we've actually seen is that despite the change in terms of some metros, with moving from a predominantly ANC-led metro to a DA, that IP and continuation of discussions has continued, particularly in the city of Tshwane, as Otis has already mentioned, around Isivuno. And I think it's something to look forward to conclude that particular lease. I think at Tegwini Municipality, we are well in advance with the city of Tegwini to basically house them at Shell House. I think they occupy fully that building, and we anticipate another 3,000 square meters, because that building is actually over occupied we anticipate that we'll probably get about 3,000 square meters out of Shell House, where we can deploy those additional staff members in the adjacent Delta buildings within those nodes. Our outlook, I think we have a defensive tenant in government. Unlike some of our competitors in the listed property sector, where in a tough economic environment, people, file for bankruptcy. Hopefully, our government doesn't file for bankruptcy because we are all in trouble. I think Greece comes to mind because if government, as I keep reiterating, where government go bankrupt, basically the whole country is in trouble. So our view is that, I think given that government is basically taking early measures to basically constrain their spending, Delta's business case is still very much intact, and I think, we get investors that either like the exposure, that don't like the exposure. But, I think there's very clear distinction between two camps. We tend to fall into the ones where we understand the strategy, and I think we wish the Treasury guys very well in terms of managing their budget very well, so that may long continue that basically they continue to pay on their rentals as they've been continuing. I think finally, as we've already mentioned, we have narrowed our band in terms of the 7 to 8% band in terms of the forecast. We've basically narrowed that to between 7 and 7.5%, and we're still very much intact. That guidance still very much, we are still sticking to that guidance, particularly now that we're basically halfway through the financial year, and I think we've got a lot more visibility in terms of what's going to happen for the balance of the year. And I think we are very, very comfortable with where the fund is. I think a lot of work is happening, as you can see from the slightly elongated presentation today. And I think on the one-on-ones, we'll pick up with a lot more value that we can share on a one-to-one basis with our shareholders. I think at this point, thank you very much for your time and thank you for listening. I do know that there was a lot of information to process. And at this point, I'm quite happy to take questions from the room or from those on the webcast as well. Okay, all right, thank you. There doesn't seem to be any questions, and I think we'll probably, the management is here, and we've got some of our team from our asset management team for further discussions for those of you that maybe feel more comfortable in asking questions on a one-on-one outside. Thank you very much. Okay, sorry, there's somebody on the webcast who's got a question.
The question is from Bandile at Standard Bank. He's asking, Otis mentioned you're having challenges in Bloemfontein in renewing leases. Can you elaborate on that?
Just turn it maybe.
Thanks, Wandile. I think in Bloemfontein, we bought a portfolio that's made up of national and provincial. On the national leases, we're getting renewals. On the provincial, it's taking slightly longer to get the renewals. Notwithstanding that, they continue on a month-to-month. In a twisted way, we're benefiting from that because they're paying higher rentals on a month-to-month basis. But given the positioning of our buildings, we're not too concerned if they were to move out. Our buildings are well located, and I think in time, we'll get the lease renewals coming in. It's only on the provincial ones where we're struggling a bit.
Okay, thanks, Otis. All right, well, thank you very much for listening, and we can pick up on further discussions, as I said, I think when we take refreshments. Thank you.